Hey everyone, semiconductor stocks are gaining popularity because the role they play in fueling the growth of artificial intelligence. So in this video, I'm going to compare two semiconductor stocks, ASML and Micron Technology, to answer which one I think is the better buy today. So let's jump into this comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first thing I'm going to look at is revenue, and looking at this metric, you can see ASML has done a better job than Micron Technology with 29.83 billion in its most recent trailing 12-month period compared to 16.18 billion for Micron. You can also see ASML more stable revenue growth, whereas Micron is more cyclical. The semiconductor industry in general is more cyclical. ASML is a bit of an outlier because of its pricing power, because of its near monopoly, you can call it, in its the sale of its products, and that's why you can see better revenue growth, less cyclical compared to Micron Technology. The next thing I wanted to look at is operating profit margin. And again, you'll see a more stable increase in operating profitability for ASML with 32.81%, which is an excellent operating profit margin. And Micron had been even better than ASML at one point, at the heights of the cyclicality, but now it's down negative 39.36%. I wouldn't be surprised if this turns upward over the next 12 to 24 months as the replacement cycle of consumer electronics heightens over the next 2 to 3 years. But for now, ASML in the lead in this metric by a wide margin. I want you to understand the importance of the cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So that being said, you can see ASML again in the leadership position here at 19.75% compared to 12.47 against Micron. But you can also see Micron had the lead again in early 2018, 2019, and 2020. And then when it experienced its cyclical downturn, ASML took the leadership position. So this seems like it's going to be an up and down trend here, with Micron and ASML taking over leadership position in both the operating profitability and the cash flow from operations metrics. Over the next couple of years, you can see the prospects for Micron revenue growth is phenomenal for 2024 and 2025. 46% revenue growth expected in 2024, 41% expected in 2025, and then a slowdown to 6.9% in 2026. So again, cyclical growth. Two upcoming years expected to be phenomenal growth for Micron, and then a slowdown in 2026. For ASML, meanwhile, it's a more gradual improvement, 0.4% growth expected in 2024, 24% in 2025, and then 11.7% growth expected in 2026. So slower growth to begin with for ASML expected here, and then faster in 2025 and 2026. Still, overall, Micron is expected to grow more when you look at the 40, 40, and 7 compared to ASML with 0.4, 24, and 11.7. So I also want to finally compare valuation, and the metric I'm choosing here is the price to earnings ratio, and I want you to understand why this is important as a valuation metric. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. All right, so now that you've got an idea, you can see ASML is trading at nearly 3 times the valuation of Micron. However, I think ASML has deserved this premium valuation due to its better cyclicality or less cyclicality in the business, its stronger market share, its stronger pricing power, all of which are reasons why I would prefer to pay this premium price and buy ASML stock over Micron Technology if I was looking for one of these two excellent growth stocks to buy. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.